Picture this. March 2020. The world is shutting down, stock markets are collapsing, and suddenly every country on Earth needs the same thing. Dollars, not their own currency, not gold, not Bitcoin, American dollars. Banks in London, corporations in Seoul, governments in Brazil, everyone's scrambling for greenbacks. The global financial system is having a heart attack, and the only medicine that works comes from one place: the Federal Reserve. But here's the problem. Most countries can't just call up the Fed and ask for a loan. That's not how it works. That would be borrowing. And borrowing from America comes with strings, conditions, public humiliation. So instead, they do something else. Something quieter. Something that sounds boring and technical, but is actually one of the most powerful financial mechanisms on the planet. They swap. And by the end of this video, you'll understand why this swap system might be the most important economic arrangement nobody talks about, and why it reveals something deeply uncomfortable about how the global economy actually runs. Let's start with the crisis. When COVID hit in early 2020, the immediate problem wasn't just the virus. It was liquidity, cash flow. The gears of global finance started seizing up because nobody knew what anything was worth anymore. And in moments like that, everyone wants the safest asset they can hold, which, whether you like it or not, is the US dollar. But why? The US wasn't handling COVID better than anyone else. The American economy was cratering too. So why the mad dash for dollars? Because the world economy is built on them. Think about it. If you're a European airline buying a Boeing jet, you pay in dollars. If you're a Japanese company importing oil from Saudi Arabia, you pay in dollars. If you're an emerging market government that issued bonds to international investors, those bonds are probably denominated in dollars. The dollar isn't just America's currency, it's the world's operating system. And when that system glitches, when markets panic and everyone tries to hold cash at the same time, something terrifying happens. A dollar shortage, not because there aren't enough physical dollars in existence, but because the dollars that exist are stuck, locked in the wrong accounts, the wrong countries, the wrong hands. And if you're a bank in France or a corporation in Mexico and you suddenly can't access dollars to pay your obligations, you're in trouble, real trouble. So what do? Traditionally, when a country needed dollars fast, it had a few options, none of them good. Option 1, sell your own currency to buy dollars on the open market. But when you're desperate, everyone knows it. Your currency collapses. The dollars get more expensive. You're paying a terrible price, and the world is watching you bleed. Option 2, go to the International Monetary Fund. Ask for a loan. Subject yourself to conditions, austerity measures, policy changes. Let technocrats from Washington tell you how to run your economy. It works sometimes, but it's slow, and it's humiliating. Option 3, burn through your foreign reserves. Hope you have enough saved up. Hope the crisis doesn't last too long. Hope you don't run out. None of these are good. They're all painful. They all signal weakness. And in finance, signaling weakness can make everything worse. But there's a fourth option, and it's brilliant in its simplicity. You call the Federal Reserve, and you propose a trade. Here's how it works. And this is where it gets interesting. Let's say you're the European Central Bank. It's March 2020. European banks need dollars, desperately. But you don't want to look desperate. So you activate your swap line with the Fed. You say, we'll give you euros. You give us dollars. We'll agree on an exchange rate right now. And in a few months, we'll swap back at the exact same rate. That's it. That's the deal. The Fed creates dollars, just adds them to a digital account, and sends them to the ECB. The ECB does the same with euros and sends them to the Fed. Both sides now have each other's currency. The ECB takes those dollars and lends them to European banks that need them. Crisis averted. Markets calm down. Everyone breathes easier. And here's the clever part. It's technically not a loan. It's a swap, a temporary exchange. No interest rate, no conditions, no IMF inspectors, no public shame. You're not borrowing dollars from America. You're just swapping. For a while, it's the financial equivalent of a save point in a game. You're not losing. You're just preserving your position until the storm passes. Then you reload and continue like nothing happened. Except, of course, something did happen. Let's talk about what this actually means. The Federal Reserve has swap lines with 14 central banks. 5 of them are permanent. The rest get activated during emergencies. The permanent 5? The European Central Bank, the Bank of Japan, the Bank of England, the Swiss National Bank, and the Bank of Canada. Notice a pattern? These are all rich, developed, Western-aligned economies, America's closest allies. The temporary lines? Those get extended during crises to places like South Korea, Brazil, Mexico, and Singapore, countries that are important but not quite in the inner circle. And everyone else? They don't get a swap line. They get to watch and wonder. Because here's the thing about this system. It's completely discretionary. The Fed can give you a swap line or not, extend it or cancel it. There's no formal criteria, no application process, no legal obligation. It's a privilege, not a right. And that creates a very particular kind of power dynamic. Think about the numbers for a second. During the 2008 financial crisis, the Fed extended over $580 billion through these swap lines. More than $500 billion created and distributed to foreign central banks. During COVID, the number was even bigger. At the peak in May 2020, there was nearly $450 billion outstanding in swap agreements. That's not money Congress approved. That's not aid or grants or traditional loans. That's the Federal Reserve using its ability to create dollars to backstop the entire global financial system. And it worked. Markets stabilized. The panic subsided. The system didn't collapse. But here's what nobody really talks about. The Fed just became the lender of last resort for the entire planet. Not just American banks, not just the US economy, the whole world. And they did it quietly. No grand announcement, no political debate, just a series of coordinated statements with other central banks, released on weekends, written in the most boring technical language possible. If you weren't paying attention, you'd miss it entirely. But if you were paying attention, you'd realize something profound had just happened. The Federal Reserve had revealed its true role in the global economy, not just as America's central bank, but as the central bank of the dollar system itself. And the dollar system is everywhere. Let's zoom out for a moment, because this gets to something deeper. Why does the world run on dollars in the first place? It's not because the dollar is backed by gold anymore. That ended in 1971. It's not because America has the biggest economy. China might have that soon if it doesn't already by some measures. It's because of infrastructure, network effects. The entire plumbing of international finance is built for dollars. Every major bank has dollar accounts. Every commodity exchange prices in dollars. Every country holds dollar reserves. Every international debt market is dominated by dollar-denominated bonds. Switching away from that would be like trying to change the operating system on every computer in the world at the same time. Possible in theory, catastrophic in practice. So countries are stuck. Even countries that don't particularly like America. Even countries that actively compete with America. They still need dollars. And when a crisis hits, they need them fast. That's when the swap lines matter. Because the Fed can say yes, or the Fed can say no. And that decision, that simple binary choice, can determine whether your economy holds together or falls apart. Now, the Fed will tell you this isn't about power, it's about stability. Financial stability benefits everyone. When the global dollar system works, trade flows, markets function, and growth continues. When it breaks down, everyone suffers. And that's true. Mostly. But it's also incomplete. Because stability for whom? Stability on whose terms? The countries that get permanent swap lines don't have to worry. They know the Fed has their back. They can take bigger risks, run different policies. Their banks can be more aggressive because they know there's a backstop. The countries that don't have swap lines, they have to be more careful, more conservative. They have to hold bigger reserves, limit their exposure to dollar-denominated debt, run surpluses to build up buffers. In other words, they have to play the game differently because they don't have the same cheat codes. And this creates two tiers, countries with access and countries without. The irony is perfect. The system that's supposed to promote free markets and equal opportunity has created one of the most unequal structures in global finance. But here's where it gets weirder. The system is expanding, quietly. slowly, but undeniably. In 2008, the Fed had swap lines with 14 central banks. Then those expired, and they kept just the permanent 5. Then COVID hit, and they reactivated 9 more. Then, in 2021, they made one with the Reserve Bank of Australia permanent. The trend is clear. More countries are getting access, the network is growing, and on the surface that sounds good. More stability, more cooperation, more countries protected from dollar shortages. But think about what that actually means. It means more of the world economy depends on the Federal Reserve. More countries whose financial systems are backstopped by an institution they don't control, an institution that's legally obligated to serve American interests first. The Fed's mandate is to maintain stable prices and maximum employment in the United States, not in Europe, not in Japan, not anywhere else. So what happens when American interests and global stability conflict? What happens if the Fed needs to tighten policy to fight inflation in the US, but that creates chaos in emerging markets that borrowed in dollars? What happens if geopolitics intervenes? If America is in a trade war or a Cold War or an actual war with a country that desperately needs a swap line? These aren't hypothetical questions. These are the pressure points in the system. And here's the thing that should make you uncomfortable. Nobody voted for this. Nobody debated whether the Federal Reserve should become the world's emergency dollar provider. It just happened. Crisis by crisis, swap line by swap line. It happened because it had to. Because there was no alternative. Because when the global financial system is melting down, you don't have time for philosophical debates about sovereignty and power and the proper role of central banks. You do what works, and the swap lines work. But working and being sustainable are two different things. Because this system runs on trust. Trust that the Fed will activate swap lines when needed. Trust that it won't use them as a political weapon. Trust that the dollar system itself will remain stable. And trust in international relations is a renewable resource right up until it's not. Countries are already trying to build alternatives. Currency swap networks that don't involve the dollar. Regional payment systems. Digital currencies. Anything to reduce dependence on the Fed's goodwill. China has swap lines with dozens of countries in yuan. The EU keeps talking about increasing the international role of the euro. There's constant chatter about moving away from dollar dominance. But chatter is easy. Infrastructure is hard. And the infrastructure is still overwhelmingly dollar-based. So for now, the system persists. Countries complain about American financial hegemony in public and quietly maintain their dollar swap lines in private. It's the ultimate revealed preference. What they do matters more than what they say. Let's bring this back to the beginning. Back to that moment in March 2020 when the world was scrambling for dollars. The swap lines got activated. Hundreds of billions moved between central banks. The crisis eased. Markets recovered. Most people never noticed it happened. And that's exactly how the system is designed to work. Invisible, technical, boring. But it's not boring. It's one of the most consequential financial arrangements in the modern world. Because it reveals something fundamental about how the global economy actually operates. Not through democratic institutions or international agreements or formal treaties, but through networks of central bankers, quiet coordination, emergency phone calls, swap agreements that get announced in press releases nobody reads. This is the real structure of global finance, not the public institutions like the IMF or World Bank, not the dramatic summit meetings or trade negotiations. It's the Federal Reserve and a handful of other central banks managing the dollar system through backroom deals that most people don't even know exist. And the craziest part? It works. Imperfectly. Unfairly. With obvious imbalances and risks. But it works. The question is, for how long? Because every system built on trust and discretionary power eventually faces a test. A crisis where the politics override the economics. Where the countries that need help the most are the ones least likely to get it. Where someone asks for a swap line and hears no. And on that day, we'll find out what the global financial system looks like when the cheat codes stop working. So here's what you should take away from this. The next time you hear about a financial crisis, pay attention to the swap lines. Who gets them? How much? How fast? Because that will tell you more about the real power structure of the global economy than any official statement or policy document ever will. The swap lines are where the theory of free markets meets the reality of power, where the rhetoric of national sovereignty meets the practical need for dollars. They're not loans, they're not aid, they're not even really swaps in any normal sense. They're insurance, protection, a quiet guarantee that if things go bad, some countries will be saved and others won't. And the difference between those two groups isn't economic fundamentals or policy quality or rule of law. It's whether you have the Fed's number and whether they pick up when you call. That's the uncomfortable truth at the heart of the global dollar system. Not that it exists, but that it works exactly the way it was designed to, efficiently, quietly, and completely undemocratically. The swap deal that lets countries borrow dollars without borrowing dollars isn't a loophole or a hack. It's the system itself, working as intended, and nobody knows what happens when it stops. If you made it this far, you're exactly the kind of person this channel is for. 8-bit economics breaks down the systems that run the world, the mechanics most people never see, the economic code running in the background while everyone's distracted by the headlines. No fluff, no predictions about where to invest your money, just clear explanations of how the game actually works. Subscribe if you want more of this. There's a whole playlist on central banking, currency systems, and the hidden infrastructure of global finance that most channels won't touch. And if you've got thoughts on swap lines, dollar dominance, or what happens when the cheat codes run out, drop them in the comments. Some of the best conversations happen down there. New videos every week, same tone, same depth, different system. See you in the next one.